Hello everyone, my name is Jainan and I welcome you all to Echo with JP. In this channel, I will teach you everything related to commerce. I'll teach you accountings, economics, organization of commerce, and statistics. So, in the first part of accounting, we are going to learn about accounting and its terminology. Let us start with the introduction. The barter system. In the ancient time, before the advent of currency, people relied on the barter system for trade. Goods and services were exchanged directly for other goods and services without the use of money. If I wanted to buy 1 kg of sugar, then I'll give the person 1 kg of rice in exchange of 1 kg of sugar. In simple, that's the barter system. If you want something, you have to give something and he'll give you what you want. Lack of standardization. Better transaction. Lack, lack of standardization. Barter transactions lack standardization, making it challenging to determine the exact value of goods or services being exchanged. This often led to disputes and inefficiencies in the trade. What happened? That in the today also, 1 kg of sugar is not equivalent to 1 kg of rice. The price is different. Let us say that 1 kg of sugar is for 50 rupees and 1 kg of rice is for 70 rupees. So it's not equal. So in the ancient time also this was the same, that the price, the value of 1 kg of sugar was not equal to 1 kg of rice. So many disputes used to happen, controversies used to happen between the trader, that you are not giving me the exact value of what it is worth. Limited scope. The barter system limited the scope of trade, as it required a double coincidence of wants. Both parties had to desire what the other had to offer. It is true. If trade is happening between me and Raju, then if I'm giving him 1 kg of sugar, then he had to agree with me that okay, 1 kg of sugar is equivalent to 1 kg of rice. But I used to say, what if I give you 1.5 kg? Then 1.5 kg will be 1.5 kg of sugar now in this time modern world will be equal to 70 rupees and 1 kg of rice would be equal to 70 rupees. So it's equal. Then if there was double coincidence of wants or the trades, then only the trade used to happen. Now let us know about invention of accounting. First, need for record keeping. As societies evolved from simple hunter-gatherer groups to settled agriculture communities and later to complex urban civilization, there arose a need to keep tracks of resources, transactions, obligations. This need stemmed from various factors, including trade, taxation, tribute, and resource management. One of the factors regarding invention of accounting is need for record keeping. As we evolved, we entered the modern world. It was necessary to record what all transaction used to happen, what trade used to happen between kings and kings. To keep the record, accounting was invented. The second factor is economic expansion. With the expansion of trade routes and the emergence of markets, there was a proliferation of economic transaction involving multiple parties. This complexity necessitated a systematic way of recording and tracking exchanges to ensure accountability and facilitate the future transaction. The second factor for invention of accounting is economic expansion. As I told you earlier in the above point, that it is the huge world, as economy of the country will expand, right? If a country goes, like if India is growing, so its economy will also grow. To keep the track of growing growth of economy and what trade are happening between the country, accounting was invented. Third, cultural influences. Cultural factors such as religious beliefs and ethical norms also shaped accounting practices. For example, in the ancient Egypt, the concept of math, order through justice, influenced accounting practices, emphasizing honesty, accuracy, and fairness in the final transaction. In summary, accounting was invented to meet the evolving needs of humans. societies for the managing economic activities, ensuring accountability, facilitating trade, and economic government structures. It developed Its development was driven by technological innovations, economic expansion, administrative requirements, and cultural influences, ultimately laying the foundation of modern accounting principle and its practices. Accounting as per American Standards Council. It is a service activity. Its function is to provide quantitative information, primarily financial in nature, about economics entities that is intended to be useful in making economic decisions. Do you find it very confusing? Let me sort it out in a very simple way. Simple meaning of accounting. A method or a system which is maintained to keep accounts is called as accounting. That's the simple thing. What? I'll repeat it for you. A method or system which is maintained to keep accounts is called accounting. Another name of accounts are also known as bookkeeping. All the transactions which we do in our daily life are recorded. In home also, like our parents record all the transaction happen in the day, where we gave the sabji wala 20 rupees, or we paid 40 rupees for the ice cream. So it is all written in the book. Now, let us start knowing about characteristics of accounting. The first is the financial characteristics. Transaction or events which are recorded in accounting must be measurable in monetary value. Example, 10,000 kg of chemical is purchased. The value of this purchase has to determine in the terms of money. This chemical is purchased for 20,000 rupees, which means that a 10,000 kg chemical is equal to 20,000 rupees. In exchange of chemical, 20,000 rupees are payable. Rupee is money. Transaction made through money is known as economic transaction. This transaction has financial characteristics. One of the main characteristics in accounting is the financial characteristics. Every transaction happening in the day must be recorded in the monetary value. We cannot record like 10,000 of chemical is purchased, but 10,000 kg of chemical is purchased for 20,000 rupees. So in accounting, every trade has to be recorded in the form of monetary value, means in terms of money. Like in the given case, 10,000 kg of chemical 10,000 kg of chemical was bought for 20,000 rupees. It is clearly justified that 10,000 kg of chemical is bought for 20,000 rupees. 20,000 rupees is a monetary value. Second, money as a medium of exchange. Transaction or events recorded in the accounting come into existence through usage of money. Money as an exchange will be received by seller for 10,000 kg of chemical sold, and by this money he can purchase any other product or service. In trade, money has to be used as the medium of exchange. Now, the time of the ancient time has gone. We cannot do barter system to buy the chemical he is asking for. He have to pay some money to buy 10,000 kg of chemical. Then is classification and analysis of transaction. It is the third characteristics of accounting. In accounting, different types of transactions are recorded. These transactions are made in cash form or non-cash form, also known as credit transaction. These transactions are performed by any income, expenses, asset or liability based activity. These transactions are classified and analyzed on basis of their nature, which is derived from debit card. Debit credit rules of accounting, which are discussed hereafter. Due to characteristics of classification analysis, transaction or prescribed time can be seen together at one place. Example, what was opening balance of the asset? How many assets were purchased? How many assets were sold? What is the closing balance of assets? Answers of all these questions are obtained because of classification analysis. In accounting, it is very important to classify and analyze all the transactions. If I'm giving you 10,000 rupees, so it has to be classified as in terms of cash. Or if I pay through my credit card, it is classified as credit payment or non-cash form. Credit debit card we are not using the cash, right? So it is classified as non-cash form and it is very important in accounting. Fourth point is interpretation of transaction. In accounting, only accounts are not prepared, but after accounts are prepared as per the prescribed norms, they are also interpreted on the basis of disclosed details and figure, which is called as quantitative information. Example, when blood pressure of a person is measured and if it comes between 120 or 80, it indicates that the person is healthy. From the viewpoint of blood pressure, 120 between 120 or 80 is the measure of blood pressure and comment healthy. Healthy is the interpretation. In accounting, interpretation can be done from the accounts prepared. Example, total income is 20,000 and total expense is 12,000. The difference of 8,000 is the excess of income over expenses. This indicates that the person has benefited from the transaction. The difference of income and expense is the form of benefit, which is interpretation of these figures. In this manner, transaction recorded in accounting can be interpreted and the results can be understood. What does this mean? It's very simple. Its example is also given here that your income is 20,000, your expense is 12,000. The difference of 8,000 is the excess of income over expenses. So when you put this amount into your bank, the bank interprets as you have benefited from the transaction of your income and the expenses. That's the simple thing. The profit loss thing is also known as the interpretation of the transaction.